Claiming depreciation can be one of the perks of owning an investment property, but too many investors turn a blind eye to depreciation claims on older properties. Hey everyone, Kim Quach from Duotech, here for another video designed to help you become a better property investor. You can claim tax breaks on depreciating assets no matter how old the property is. Things like carpets, curtains, bathroom fittings, dishwashers and washing machines all qualify for depreciation as they age. The ATO lists all the items you can claim on and how long they should last. For example, a carpet should last 10 years, while a kitchen stove should last 12 years. But your entitlement to claim depreciation will depend on when you acquire the property. So, in today's video, we want to share how these rules impact your claim and show you how you can increase your depreciation claim with our top 10 depreciable assets. Before we get started, we want to be clear that this video is for informational purposes. In no way should you interpret this as financial advice. We always recommend working with a qualified financial advisor or tax agent to give you the best advice for your situation. After the federal budget in 2017, a few new rules were introduced regarding depreciation that would impact your claim depending on when you acquired the property. For properties acquired before 9th May 2017, investors can claim depreciation on plant and equipment assets that form part of the property according to a quantity surveyor's assessment of the asset's remaining life and value. But if you acquired the property after 9th of May 2017, depreciation only applies for costs on new plant and equipment assets you paid for and installed, or plant and equipment assets that were included as part of the new property. This means that you can't claim deductions on plant and equipment bought by the property's previous owners. It's not all bad news for investors though, because installing new plant and equipment assets can really boost your depreciation claim. This is mainly because the effective lives of these items are shorter than the general building structure, so they can be depreciated more quickly, giving a higher write-off value per year. So, if you are thinking about doing some upgrades to your property's plant and equipment assets, you should consider these 10 depreciable assets, mainly because they have a higher cost and lower effective life. So it'll allow you to claim a higher depreciation amount on your next tax return. The first item on our list are light fittings. They have a high cost and a very low effective life of 5 years. If we look at the average cost of new light fixtures, you're probably going to pay around $4,000. If we were to depreciate that using the diminishing value method, you could claim around $1,600 of depreciation in your first year. In larger properties, the cost can easily increase above $5,000, which means your first year depreciation claim could add up to $2,000. For the purpose of this video, we'll use the diminishing value method, but your tax agent or accountant will advise which method is best for your situation. Next up on our list are packaged air conditioners. Packaged air conditioning units have an effective life of 15 years and will depreciate at a rate of 13.33% using the diminishing value method. This means that if your new air conditioner costs $10,000 to install, which is the average cost at the moment, you could claim $1,333.33 in your first full year of depreciation. While the effective life is quite high, deducted air conditioning units are quite expensive, which still results in a lot of depreciation. When air conditioning is deducted, it is important to be aware that the ducting, pipes, and vents will not be part of the plant and equipment depreciation, only the unit. This is because ducting, pipes, and vents are fixed items, so it'll form part of the capital works deductions, which can be claimed at a rate of 2.5% for a maximum of 40 years. Item number 3 is artificial grass. The cost of installing artificial grass usually ranges between $2,000 and $5,000 and has a very low effective life of 5 years. So, if you paid an average amount of $3,000 to install artificial grass in your investment property's back garden, you could claim up to $1,200 of depreciation in your first year. Next up, we have floating timber. Similar to air conditioning units, floating timber has an effective life of 15 years, but it's slightly more versatile than carpet, so it's more expensive. The benefit of the higher cost is a bigger depreciation claim. If we average the cost of timber flooring, you're looking at around $7,500. If you were to claim depreciation on that in your first year of owning it, you could claim up to $1,000. The 5th item on our list is carpeting. Almost every residential investment property has carpets installed in some of the rooms. They are notorious for experiencing wear and tear or damage. So they generally have a lower effective life than timber flooring. Carpets actually have the lowest effective life compared to other floor coverings. According to the ATO, investors generally replace their carpets after 8 years, so you can depreciate the value very quickly. If you paid an average price of $4,000 to install carpets, you could claim $1,000 as a deduction on your tax return. Item number 6 and 7 on our list are curtains and blinds. Some investment properties feature blinds, some have curtains, and some even have a combination of both. The effective life of curtains is 6 years, while blinds have a 10-year effective life, so both depreciate relatively quickly. If you paid $2,700 for your curtains, you could claim up to $900 of depreciation in your first year. And if you paid $3,500 for your curtains, you could claim up to $700 of depreciation in your first year. Kitchen appliances such as the cooktop, range hood, and oven are nearly always purchased in a set, so the cost is generally quite high. On average, you can expect to pay around $4,000 to install all 3 appliances. With an effective life of 12 years, that means you could claim $666.67 in your first year of claiming depreciation. It's worth noting though that they are listed as separate assets. So in later years, these will depreciate the fastest since they can be allocated to the low value pool once each asset's residual value drops below $1,000. Next up, we have another type of air conditioning unit, the split system. Split systems have an effective life of 10 years. These will depreciate at a rate of 20% using the diminishing value method. So if you paid an average price of $2,000 to install a split system, you could expect to claim around $400 from your depreciation claim in the first year. The last item on our list is a hot water system. It has a high effective life and a lower cost than the other items on this list. But you'll claim around $300 in your first year of claiming depreciation if you pay the average price of $1,800 to install it. So there you have it. Some of the most common depreciable assets we find within residential properties. The ATO provides a comprehensive list of 6,000 depreciable plants and equipment assets that you can claim deductions for. That means it's worthwhile getting in touch with a quantity surveyor to see how a depreciation schedule can maximize your depreciation claim. Anyway, that's it from me. If you know a friend, colleague, or family member who needs to hear this, please make sure you share this video with them. I'm Kim Clutch from Duotax. See you next time.